Hey everyone, welcome back to Corporate Decoder, the place where we sift through company filings so you don't have to. Today we are decoding a filing from RiverNorth's Opportunities Fund, and trust me, it's more exciting than it sounds. Usually things like this are boring, but this filing contains plans for new stock offerings. We're going to break down what this fund is all about, what securities they are offering, and the risks involved, all in plain English. So what exactly is this document? It's a registration statement filed with the SEC, meaning RiverNorth's Opportunities Fund wants to offer more of their stock and other investment products to the public. This document lays out all the important details for potential investors. RiverNorth's Opportunities Fund, Inc., the registrant, is a fancy name for a company that is a diversified closed-end management investment company. This means it pulls money from investors and invests in other things, which are called underlying funds. It is what the SEC calls a closed-end fund. These funds raise money only once in one shot. Unlike the more familiar open-end fund, mutual funds where investors can buy and sell shares daily, RiverNorth focuses on areas to try to get you high returns like closed-end funds, exchange-traded funds or ETFs, business development companies or BDCs, and special purpose acquisition companies, also known as SPACs. Now let's dig into what the fund plans to offer. The fund may offer shares of common stock, shares of preferred stock, and subscription rights to purchase those common or preferred shares. What's the catch? They could release up to $600 million worth of these things over time. What will RiverNorth do with all that cash? Well, they expect to invest all of the offering's net proceeds within about 3 months, which is not that long to seek out attractive investment opportunities. Until it's invested, the money will sit in high-quality short-term debt securities. What if the investments don't happen? It could reduce distributions to common stockholders. So what is the ultimate goal of this fund? The fund's investment objective is total return consisting of capital appreciation and current income. They seek to get it through a tactical asset allocation strategy and opportunistically investing in things like closed-end funds, exchange-traded funds or ETFs, business development companies or BDCs, and special purpose acquisition companies, also known as SPACs. RiverNorth will put at least 80% of the fund's managed assets in underlying funds and SPACs. Also, the underlying funds won't be advised or sub-advised by RiverNorth itself or its affiliates. Manage assets simply means the total assets of the fund, including assets attributable to leverage, minus liabilities excluding the actual debt. To juice those returns, the fund may borrow money or issue preferred stock notes or debt securities. This is leveraging, and it's a tool they use. This is all a speculative technique. The fund did enter a credit agreement for a credit line with a bank, but it didn't use it. As of March 2025, the fund has about 4 million shares of Series A preferred stock outstanding. Let's get to the important part, the expenses. This table shows you the costs of investing in this fund. You need to keep an eye on these because high expenses eat into your returns. Sales load or offering expenses borne by the fund, 0. You don't want to see those because you're paying extra just to get in. Management fees are about 1.77% of your investment. That means if you invest $1,000, 17.70 goes to RiverNorth every year for managing the fund. It is essentially an all-in fee. Digging even deeper, acquired fund fees and expenses are estimated at 240%. These are the fees that the RiverNorth fund pays to the other funds it invests in. So there are fees on fees. The total annual expenses comes out to a whopping 6.69, goes to expenses 9, goes to expenses 9, goes to expenses 9, goes to expenses 9, goes to expenses every year. So what does this look like in real money? The report includes an example that helps illustrate. They assume you invest $1,000 and earn 5% per year. After 1 year, your total expenses would be $66. After 10 years, you would have paid $615 in fees. Yikes. Let's get into the meat and potatoes. What did the company actually make? Here's the good news. For the period ended December 31, 2024, the fund has a 0.4724. The fund has a 0.47 income for each share outstanding. Digging deeper from net investment income, we see 0.63, but the real money comes from net realized and unrealized gains at 0, getting shares for cheaper than what they are supposedly worth. One interesting statistic is the ratio of expenses to average net assets, which comes to about 2.14% for this period. This was 2.29% the year before. The key takeaway is that this fund does not generate big returns, but it comes with big fees for you. Warren Buffett style analysis would say this isn't a good long-term deal. The fund also issues senior securities, basically debts. In their filing as of December 31st, they are managing $97 billion of Series A preferred stock with senior securities coverage per unit of $92. It would seem that the fund makes use of debt to try and boost returns. What about the risks? Every investment has them, and it's important to know what you're getting into. Because the voting power of current shareholders is diluted to the extent that current shareholders do not purchase common shares in any future offerings of common shares or do not purchase sufficient common shares to maintain their percentage interest. This is not necessarily good for shareholders. On the other hand, this is a benefit for the business itself, who get more funding in order to operate. As the fund may borrow money or issue debt or preferred stock, there is a greater risk of loss. Since common stockholders pay all expenses related to the issuance of debt or use of leverage, the use of leverage through borrowing of money, issuance of debt securities, or the issuance of preferred stock for investment purposes, creates with leverage proceeds does not exceed the costs of leverage. The return to common stockholders will be less than if leverage had not been used. The use of leverage magnifies gains and losses to common stockholders. Shared use ed for the leverage, the return to common stockholders will be less than if leverage had not been used. The use of leverage magnifies gains and losses to common stockholders. This fund will incur the fees and expenses of its investments in underlying funds, which may be greater than if the fund invested in the securities held by the underlying funds directly. There is also the risk that the fund may suffer losses due to the investment practices or operations of the underlying funds. The fund may invest in SPACs. Investing in SPACs has added risks because the shares are frequently volatile in price. As a result, their performance can be more volatile, and they face greater risk of business failure, which could increase the volatility of an underlying fund's portfolio. Who's steering this ship? RiverNorth Capital Management LLC serves as the fund's investment advisor. The document goes on to detail some of its positions. Also, the document notes that the advisor will make available, without additional expense to the fund, the services of such of its officers, directors, and employees as may be duly elected as officers or directors of the fund. It lists people like a general counsel and compliance officer. Here's a quick peek at how RiverNorth plans to vote on shareholder matters. They prioritize accountability, alignment of management with shareholder interests, and transparency. Sounds good in theory, but keep in mind these are just guidelines. They may or may not vote with the best intentions. The financial statements offer deeper insights into the fund's performance and holdings if you are brave enough to get into them. Now let's zoom out and look at the big picture. RiverNorth Opportunities Fund is trying to raise more capital and will likely increase management fees. The expenses are high and eat into potential shareholder returns. So is this worth the investment? RiverNorth has delivered good returns in the past, however, the financial benefits don't seem to be trickling down as much as they should to the common shareholder. This seems more like a payout for the investment company and fund itself. This isn't necessarily bad, but that's important to remember. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, please remember to like, comment, and subscribe. I will see you next time.